Oh, Robinhood stock trading. So it's totally free. You just connect your bank account, transfer money in, buy whatever stocks you want, and they actually are free. There's no strings attached at all. It's a free stockbroker. You can buy all the stocks you want, and there's no charges at all. Not even hidden charges. It's the only way you can buy stocks for free on Earth. It's amazing. There's no um, minimum amount you have to deposit. There might be, I don't know. That's a possibility. But that's also besides the point. You really shouldn't be investing in individual stocks. That's idiotic. Maybe if you are some kind of professional, brilliant Omaha of Nebraska, Warren Buffett mirror, maybe then. But if not, you need to be investing in like VTI, Total Stock Market ETF, which is a fund that is basically an index fund. You want a low-cost index fund, so it will just follow all of the market, and those have averaged over 100 years 7% gains year on year. No individual investor can beat the market consistently, decade in, decade out. So if you don't want to try to beat the market and screw yourself, you should just buy a low-cost index fund. Now, VTI is nice because they also pay out dividends, and they have a combination of S&P 500 holdings as well as international holdings. So you're really hedged against any particular sector failing. Well, with what you just said about following the news in order to invest, it's a good thing you're not investing. Because that's not how it should work. You should invest whether times are good or bad. Invest as much as you can reasonably afford, and not even watch it. If the market's going down, you should keep buying. If the market's up, keep buying. You just buy, buy, buy. And that will give you dollar cost averaging, which is this idea that if you buy high, you buy low, it'll all even out, and you're buying just kind of medium. You're not trying to predict anything. You're not trying to outsmart it. And you end up getting way ahead that way. Dollar cost averaging prevents you from accidentally buying when the market's at an all-time high with all of your money at that one moment. You want to spread it out and buy at random intervals so that you'll just randomly buy at low times and high times, and it will end up being like buying it just in the middle as it averages out. And if you buy in the middle, you're not going to accidentally just buy when it was at an all-time high or something like that. There's been countless pros and self-proclaimed pros that have completely been wiped out. Very smart people, because the market is unpredictable. And those who actually can predict it eventually won't predict something. And very few people can ever beat index funds that are just passively invested into. And those who think they can end up losing a lot of money because they treat it like gambling. A disciplined investor just invests passively over time in index funds. You don't have to let AI decide when you're investing in passively non-predictive patterns in total market funds. So basically you own a tiny fraction of every big company in the whole world. And when one of those companies doubles in size, you double that amount of that tiny fraction that that company owns. And so you just own a tiny amount of everything. And if any one company goes under, it doesn't hardly affect you at all.